For decades, there's been this ghost haunting corporate boardrooms, a nagging feeling that all the money, the massive investments in information technology, might not actually be paying off. Today, we're going to dig into that long-standing mystery, the IT productivity paradox.
And just to give you a sense of the scale we're talking about here, get this. At its peak, IT investment accounted for as much as half, that's 50%, of all corporate capital spending. Companies were betting the farm on computers, and you better believe they were expecting some huge returns.
So all that spending led to one incredibly frustrating question. With billions upon billions pouring into technology, why wasn't productivity just skyrocketing? This puzzle baffled executives and completely stumped economists for years.
So, to really unravel this, here's how we're going to break it down. We'll start with the paradox itself, then look at a groundbreaking new way of thinking about it, see how researchers actually measure the impact, discover the crucial connections they found, and finally, talk about what it all means for understanding the true value of tech today.
Okay, let's start with the heart of the mystery, what economists famously called the productivity paradox. We're going to get to the bottom of why the data just didn't seem to add up.
And this is where things get really weird. Just look at this. For every single study that found a positive return on IT, another one would come out finding it had zero effect, or in some cases, even a negative impact. It was a total mess, a statistical dead end.
So this contradiction, that became the paradox. As spending on computers went up and up and up, overall productivity just kind of flatlined. And the big, scary question hanging over everyone was, are we just wasting billions and billions of dollars on this stuff? And this is where the story takes a really fascinating turn. Let's talk about a process-oriented view. A group of researchers came along and proposed this kind of radical idea. They asked, what if the problem isn't the technology at all, but how we're trying to measure its value in the first place?
Think about it like this. It's like judging a car's performance only by its top speed without ever popping the hood to look at the engine. By focusing only on these huge, big-picture numbers like total sales or profits, everyone was completely missing the story of how technology was actually helping the business run day in and day out.
So instead, they suggested looking at a business as a value chain, a whole series of interconnected processes. It's kind of like a relay race, right? From managing your suppliers to actually producing stuff, to marketing, and finally to dealing with your customers. IT could be making a huge difference at every single one of those handoffs, not just at the finish line.
Okay, so if the theory is that IT is impacting all these individual steps, the next question is, how on earth do you measure that? Well, the researchers' solution was surprisingly simple, almost obvious in hindsight. Why not just ask the people who are actually running things?
And that's exactly what they did. They went straight to the source. They surveyed 180 senior execs from these huge companies. And their logic was pretty solid. These are the people who use the IT, who rely on the reports it generates, and who make the big decisions about where to invest. Who better to ask about its real-world contribution?
And after analyzing all those surveys, they were able to boil it all down to 7 key areas where IT was delivering real, tangible value. You can see them here. From making supplier relations smoother, all the way to giving a company a competitive edge. This was a way more detailed picture than just looking at one big productivity number.
Which brings us to our next section, connecting the dots. Now, what we've talked about so far was already a huge leap forward in solving the paradox. But believe it or not, their most powerful, really game-changing insight was still to come.
So, at first, they tested a model where each of those 7 areas was basically its own little island, contributing value all by itself. And you know what? The results were pretty good. The model was a solid fit for the data they had collected. But the researchers, they had a hunch there was more to the story.
This led them to ask a critical what-if question. What if the true power of all this technology isn't just in making each department a little bit better, but in making them all work better together? What if the real magic happens when you start linking all those processes?
And that led them to build a second model, the value chain model. This one accounted for all the connections between the processes, like how improving your supplier relations then cascades down and improves your production. The result? It was a near-perfect fit for the data. Suddenly, it all clicked. The true value wasn't in the individual parts, it was in the connections between them.
And that brings us to our final takeaway, the real value of IT. The big lesson here is that it's not about the parts, it's about the connections.
So what does this decades-old research really tell us about technology in our world today?
Well, here's the bottom line. That whole productivity paradox, it wasn't really about useless technology. It was a measurement problem. To see the real value of IT, you have to look deeper at its impact on specific business processes. But, and this is the most important part, the greatest contribution of technology isn't just improving isolated tasks. It's about creating synergy. It's about integrating the entire business to make the whole thing way, way greater than the sum of its parts.
And that leaves us with one last question to think about. In our own jobs, the technology you use every day, is it just making your little island more efficient? Or is it actually building bridges to everyone else, connecting that entire value chain? Because that, as it turns out, is where the real value is hidden.